Hey everyone, welcome back to Corporate Decoder. Today, L.Q.R House Inc. just filed an 8K revealing a significant stock sale, and I am seeing some big numbers that need a closer look. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company announced a massive sale of its own stock, and the number of shares outstanding has changed dramatically. Alright, let's dive into what happened. L.Q.R House Inc., ticker symbol YHC, filed this report to update everyone on some important activity. The main event here happened on the 30th of June 2026, and then a bit more on the 1st of July 2026. This company, L.Q.R House Inc., which you might know as YHC on the Nasdaq, is primarily involved in consumer defensive products, specifically wineries and distilleries. It is a pretty small company with only about 4 employees and a market cap of just $1 million. Even though the PE ratio is currently very low at 0.2. The stock price has seen a lot of volatility, trading between $0.04 and $11.14 over the past year. Their common stock is traded on the Nasdaq Stock Market LLC, and interestingly, they are electing to be treated as an emerging growth company, which means they can use extended transition periods for new accounting standards. Under the section Other Events, they have disclosed a major transaction that essentially involves them selling a lot of their own stock back into the market through an agreement they had with AGP Alliance. Global partners. This is often referred to as an at-the-market offering, where a company can gradually sell its own shares. Let's break down the numbers. On the 30th of June 2026, L.Q.R House sold a huge chunk of shares, 57,100,000, at $0.1063 each. That brought in about $6.07 million. Then the very next day, the 1st of July 2026, they sold another 19,250,000 shares, but this time at a lower price of $0.0539 per share, bringing in about $1.04 million. Now, here is where it gets really interesting, right? Before these sales, L.Q.R House had just over 21.5 million shares outstanding, but after selling all those shares, the total number of shares outstanding skyrocketed to over 97.8 million shares. That means the number of shares has increased by more than 4.5 times in just a couple of days. This is a significant dilution event for existing shareholders. Think about it this way, if you owned 100 shares before, you now own fewer than 25 shares relative to the total. This massive increase in shares outstanding is a way for the company to raise capital quickly, but it significantly reduces the ownership percentage and potential value of each existing share. We have seen companies like Radio Shack go through multiple dilutive offerings and reverse splits. And historically, many micro-cap companies that do such large dilutive sales often face delisting down the road. For context, when Kodak did a 1-for-20 reverse split in 2021, holders saw roughly a 40% additional drawdown over the following 90 days. A $1,000 position there became about $600. While this isn't a reverse split, the massive dilution is a comparable concern for share value. The company also has its common stock with a par value of $0.0001 per share, trading under the symbol YHC on the Nasdaq Stock Market LLC. Looking at recent news, there was a report on the 30th of June about L.Q.R House signing a 2-year agreement with ByteDance to use AI compute for quantitative research. This could be a positive development, but it comes at a time when they are also aggressively selling their own stock. It is important to balance these events. The report is signed by Sean Dollinger, the Chief Executive Officer, on the 2nd of July 2026, just after these stock sales occurred. So, what is the story here? L.Q.R House Inc. is raising a significant amount of cash, over $7 million in a couple of days, by issuing a massive number of new shares. This dilutes existing shareholders considerably. While they are also involved in AI and technology partnerships, the sheer volume of stock issuance is a major red flag for anyone holding the stock. The risk I'm watching is how this massive dilution impacts the stock price and the company's ability to regain investor confidence. What I'm actually looking for is whether these cash inflows translate into sustainable growth or if they are just a temporary fix for financial needs. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown useful, hit like, subscribe for more deep dives, and join our Discord using the link in the description.